All right, welcome to The Explainer. Today we're diving into something every single trader needs to master: how to steer clear of that dreaded margin call. Seriously, if you get this wrong, it can sink your entire account faster than just about anything else. So let's make sure you're ready for it. Let's kick things off with a question. What's that one silent threat lurking in your account, the one that can make everything just disappear? The answer: a margin call. And let's be absolutely clear about this. If you don't understand this concept, the source material says you are, and I quote, doomed to fail as a trader. It really is that serious. This isn't just some friendly heads up from your broker. It's the fire alarm for your account. So why do we call it a trader's worst nightmare? Well, because it usually strikes when you're already in a tough spot. And for traders who aren't paying close attention, it comes as a complete and total shock. We're going to make sure that's not you. Here's the classic mistake, and you see it all the time. New traders get completely obsessed with the charts, right? They're looking for the perfect pattern, the perfect indicator, but they totally ignore the simple math happening inside their own account. So the very first step to avoiding a disaster is to actually understand what a margin call is and how the whole thing works. And that leads us to this crucial point. You have to know your numbers. You need to know your broker's margin requirements inside and out before you even think about placing a trade. This isn't just a good idea, it's your first line of defense. Okay, so let's break it down. There are 4 numbers you need to watch like a hawk. First up is your equity. That's easy. It's the total value of your account, your whole piggy bank. Then there's used margin. Think of this as the money that's been locked away to keep your current trades running. Whatever is left over, that's your free margin. That's the cash you have on hand to open new positions. And finally, the big one, your margin level. This is a percentage, and you can think of it like a fuel gauge. If that gauge drops into the red zone, well, that's when the alarm bells go off, and a margin call is right around the corner. I mean, picture this. You set a pending order, maybe you even forget about it. The market makes a move, that order gets filled, and bam, your margin level suddenly tanks. If you weren't watching, that's exactly how you get blindsided. You have to account for the margin impact of every single order, whether it's active or just pending. All right, so we know the numbers to keep an eye on. Now let's talk about the single most powerful tool you have to protect yourself. Let's talk about your safety net. And what is that safety net? It's the stop loss order. According to the source material, if you don't know what this is, or worse, you're not using one on every single trade, then you're on your way to losing a lot of money. A stop loss is like your automatic ejection seat. It gets you out of a nose-diving trade before it turns into a complete catastrophe. Let me show you exactly how this works. Let's say you go long on USD JPY, but you smartly place your stop loss just below your entry point. If the market suddenly turns and takes a dive against you, your position is automatically closed out at that level you already decided on. Just like that, your loss is capped. Yeah, does it sting to take a loss? Of course. But a small, controlled loss is a million times better than a massive one that blows up your account. Another huge reason traders get into trouble? Pure, simple overconfidence. They think they've found the perfect trade, so they go all in with a massive position, and then they just watch in horror as the market does the exact opposite of what they expected. But there's a much smarter, more professional way to do things. It's called scaling in. So instead of placing one giant risky bet, you build your position piece by piece with several smaller entries. This gives you so much more flexibility and helps you manage your risk if, your timing isn't quite perfect. What's so interesting here is just how different these two approaches are. I mean, look at this. On one side, you have the emotional gambler, going all in, it's high risk, it's stressful. On the other side, you have the strategic trader, patiently building a position, spreading out the risk, and drastically lowering the chance of a margin call. So, which trader do you want to be? And that brings us to our final, and maybe the most important point of all. Because all the tools and tactics in the world don't mean a thing if you don't have the right mindset. It's about really, truly knowing what you are doing. It's a story you hear all the time. A new trader gets a margin call and is completely floored. They have no idea how it even happened. And it's because they were so focused on the potential profit, just dreaming about how much they could make, that they were completely blind to the very real risks staring them in the face. That's a mistake we just can't afford to make. So here it is, the key takeaway. It's a complete shift in how you think. Your number one job as a trader is not to make a profit. Your number one job is to protect your capital. It's to manage your risk. If you can do that well, the profits will eventually follow. But if you ignore risk, you won't even be in the game long enough to see them. The legendary investor Peter Lynch really said it best. Even the absolute pros are wrong a lot, like 40% of the time. Success isn't about having a crystal ball, it's about making sure that when you are wrong, the damage is small and manageable. That is how you avoid a margin call. So the question I want to leave you with is this: are you trying to be a fortune teller, or are you focused on being a risk manager?